Stop everything you are doing. For decades, people have asked, should I buy a rental property or invest in the stock market? They see neighbors flipping houses, hear stories of stock market millionaires, and think one path is a guaranteed road to riches. But in 2025, the game has changed. Interest rates are high, the property market is cooling, and the stock market is volatile. You need to be smarter than ever. This is your financial future. A wrong move now could cost you your retirement or trap your money for years. So let's settle this debate with hard numbers, not dinner party stories. We'll compare a buy-to-let property, with all its headaches, to a simple, low-cost global index fund. Which one truly has the power to make you wealthy? Which is right for you? You need to understand every detail before you invest a single dollar. This is the ultimate showdown: bricks and mortar versus the global economy. Many people are emotionally attached to property. You can see it, touch it, and say, this is mine. But feelings don't pay the bills or fund your retirement. We must look past the emotional appeal and get to the financial facts. Is that feeling of ownership worth the lower returns, higher costs, and sleepless nights? Or is the hands-off approach of index funds the smarter path? The world is different now. The easy money in property might be gone. High interest rates have changed the math on mortgages. Meanwhile, global companies continue to innovate, powering the stock market forward. You must make the right choice for your money in today's world, not yesterday's. So, put your emotions aside, open your mind. Let's dive into the data to see which investment will truly make you richer. Let's look at the history books. Major global studies like the Jordan Schuleric-Taylor Macro History Database have tracked housing and equities for over a century. Over the long term, both residential real estate and stocks delivered similar total returns, about 7% per year after inflation. But the journey was different. Stocks were much more volatile, with bigger booms and busts. Housing was smoother, making people feel safer. This lower volatility is a key feature of the housing market. However, this long-term view hides important details. The post-World War II era was a golden age for both, but the next 50 years will look different. We face new challenges: slowing population growth, the shift to a green economy, and higher interest rates. The past is a guide, not a guarantee. The big takeaway: both property and stocks have been excellent long-term investments, but neither is a get-rich-quick scheme. If the total returns are so similar, what really separates them? The answer lies in how they generate returns, the risks and the effort required from you. History gives us context, but the devil is in the details of today's market. Every investment makes you money in two ways: income and capital growth. Capital growth is the increase in the asset's price, like a house rising in value or an index fund's share price going up, but this is only half the story. The second engine is income. For property, it's rent. For index funds, it's dividends. While dividends are usually smaller than rent, reinvesting them has a massive impact on your wealth through compounding. For housing, most real return comes from rental income, not price growth. Capital growth in housing after inflation is often quite low over the long run. People who just buy a house and hope its price will skyrocket are gambling. For stocks, the picture is more balanced. Capital growth and dividends both matter. In many decades, reinvested dividends have accounted for nearly half of total stock market returns. That's why I always tell you to invest in funds that automatically reinvest dividends. So, for property, income is king. For stocks, income is a powerful partner to growth. Understanding this changes how you should evaluate each investment. Let's talk about rental income, the most misunderstood part of property investing. The key number is rental yield, annual rent as a percentage of the property's value. For example, a $250,000 property with $15,000 rent gives a 6% gross yield. But that's before costs: mortgage, insurance, repairs, agent fees, and vacancies. Your real return is the net yield, what's left after all costs. That 6% gross might become 3–4% net before tax. Compare this to a global index fund's dividend yield, maybe 2% per year. But here's the difference: almost no direct costs, no tenants, no repairs, no empty periods. The dividend just arrives in your account. This highlights the trade-off: property offers higher headline yields, but comes with costs, effort, and unpredictability. The income from an index fund is lower, but far more passive and predictable. The net difference between a 3% net rental yield and a 2% dividend yield is smaller than you think, especially when you factor in your time and stress. Be honest with yourself. Are you prepared to be a landlord? How do we measure housing returns accurately? The headline numbers, like the UK House Price Index, are misleading. They only show capital growth, not rental income. Newer research includes rental yields to create a total return for housing, allowing a fairer comparison with stocks. But there's still a problem. These are national averages. Property is hyperlocal. Your experience in London is different from Liverpool. Some experts argue that, after all costs, the real long-term capital growth of residential property is close to zero. In this view, net rental yield is the only significant real return. Unless you're buying in a location with a fantastic rental yield, property isn't a great investment. This debate matters. If you believe property prices always go up, you might accept a low yield. But if net rental income is the only reliable profit, you must focus on that number. You'd never buy a property with a low yield, no matter how much you think its price might rise. This makes property investing a disciplined, cash flow-focused business, very different from the passive nature of an index fund. Let's get practical: costs, taxes, and your time. The differences between property and index funds are enormous. Liquidity. Index funds are highly liquid. You can sell shares quickly with minimal cost. If you need money, you can access your capital almost instantly. Property is one of the most illiquid assets. Selling takes months and is expensive. Transaction costs, stamp duty, agent fees, legal fees, capital gains tax can add up to 5 to 10% of the property's value. Your property has to increase in value just to break even. Index funds require zero management. Buy, hold, and review once a year. A buy-to-let property is a part-time job, finding tenants, handling repairs, and more. Even with an agent, you pay 10 to 15% of rent and still make big decisions. Taxes. UK landlords can't deduct all mortgage interest from rental income. Tax treatment is less favorable. In contrast, index funds in an ISA or SIPP are tax-free. That's a huge advantage for index funds. Leverage. The double-edged sword of property investing. Leverage means using borrowed money. You control a large asset with a small deposit. It magnifies your returns. If the house price rises, your return on investment is huge. No bank will lend you that much to buy shares in an index fund. This is property's superpower. When prices rise and rates are low, leverage works like magic. But leverage also magnifies losses. If prices fall, your losses are just as big. You still owe the bank the full amount even if the property value drops. Negative equity is a real risk. Leverage adds a huge amount of risk, a risk most stock market investors don't have. Companies in an index fund also use leverage, but the risk is spread across hundreds or thousands of companies. If one company fails, it barely affects your investment. With a mortgage, all the risk is on you and your one property. If things go wrong, you're personally responsible for the loan. The 20,000 gustaan ban odisen software was dal 5 UK market, a tough climate for new investors. Buy-to-let property is challenging. High interest rates mean higher mortgage costs. For many, mortgage payments are now higher than rental income. Negative cash flow is common. Landlords are betting on future house price growth, but with high rates, growth has stalled or fallen. It's a difficult time to make buy-to-let work. What about the stock market? Global index funds have had bumps, but the outlook is steadier. Global economic growth is steady. Corporate profits are growing, and dividend yields remain consistent. In 2025, the comparison is stark. Buy-to-let faces high rates, tax changes, and stagnant prices. Index funds are more liquid, cheaper, and more tax efficient. For most people starting today, index funds look smoother and more promising. Your path to wealth. Diversify, simplify, and decide. For most people, especially beginners, the evidence points to low-cost, global stock index funds, simpler, cheaper, more liquid, and less stressful than being a landlord. You don't need to be a property tycoon to become wealthy. The most important principle: diversification. A buy-to-let is the opposite. All your capital in one asset, one street, one city. A global index fund is true diversification. Thousands of companies, dozens of countries, many sectors. It's the smartest way to protect and grow your money long-term. If you love property and have the expertise, there are still ways to invest, like real estate investment trusts, REITs. REITs give you property exposure with liquidity and diversification. It's a smarter way for most people to get a piece of the property pie without the headaches. Ultimately, the choice is yours, but make it informed, not emotional. Look at the numbers, be honest about costs, taxes, and time. For most, the most reliable path to wealth is a diversified portfolio of low-cost index funds. It may not be glamorous, but it's proven for financial freedom. Be smart, be disciplined, and you will be approved.